5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Dani with your Bloomberg Brief. Let's get you set up for the day. Stocks bouncing back. U.S. stocks recovering from a 5-week low after the U.S. ends another round of strikes on Iran. Spending concerns. Oracle falls as data center costs overshadow AI growth. And countdown to the SpaceX trading debut. SpaceX is setting to price today after attracting demand worth 4 times the shares on offer. Let's get a check on markets around the world now. Is this bounce universal? Winnie Su, what's the latest from Asia?
Yeah, good morning, Bonnie. As you can see, it has been a very volatile day in Asia. But yes, we are seeing stocks pairing earlier losses after those headlines that the U.S. has completed its latest strikes on Iran, and also as oil reversing earlier gains. And that's why you can see here that the South Korea's Kospi index and Japan's Nikkei 225 both reversing earlier losses and closing in the green. Now, you flip the board and take a look at the biggest drag in the region today is in fact in Hong Kong and Chinese shares. You have the MSCI Asia, China here, in fact, down 1.2%, but just around 1% away from entering bear territory. And also the HSI index now hovering around that 11-month low. This is coming a lot from that drag in the Alibaba shares after the government warned of false advertising from these e-commerce platforms, and also some concerns around the AI token pricing. But overall, these Hong Kong and Chinese markets have really been underperforming so far this year on the weak earnings and the lack of AI exposure.
Winnie, thank you so much. Winnie Su there in Hong Kong. Now let's get over to London for a look at Europe with Justina Lee. Justina.
Happy ECB Day, Vani. But before we turn to that all-important rate decision, let's have a look at European markets today. The Stoxx Europe 600 rebounding a little bit, kind of following, a similar kind of optimism also in the U.S. Now, a lot of that is being driven by ASML, also kind of riding that tech recovery that we're expecting to see in U.S. markets. Now, before the ECB decision later today, we're seeing kind of German bond yields come down a little bit, also following, like a slightly lower oil. Now, of course, when it comes to that ECB decision coming later today, now, basically traders have priced in a 25 basis point hike when it comes to the policy rate. And so I think a lot of that attention will be, what is the central bank projecting when it comes to the inflation and economic outlook for the rest of the year? Because what everyone seems to be kind of split on is whether by the end of this year, we're going to get 2 or 3 rate hikes. And I think for that, there will be a lot of attention on what, Christine Lagarde says later today.
Exactly. We'll be following it very closely here, the rate path, as it were. Justina, thank you so much. Justina Lee in London. To that end, a lot of positive catalysts back in this market. So we did have a second round of strikes on Iran that appears to be over with not much of a response on the Iranian side. That's injecting some optimism. And of course, the inflation data wasn't as fear-inducing for a rate hike as perhaps it might have been. So we are seeing a rebound. Now, bear in mind, the Nasdaq was up almost 13% year to date, even with the drop that we got before today. So if this continues into the session, we might get even further of a rebound. S&P futures, Russell futures also higher. It does bear mentioning that oil did top $95 a barrel on the Brent prompt month contract earlier when the strikes were happening. It's well below that now at around 92, 93. In terms of yields, we're right back to where we were essentially. We haven't come down too much, but then we also didn't go up too much after the inflation data. So the losses that we saw, we recovered from. The 2-year yield for 12.67, that 10-year yield staying around the 4.53.24 mark. So this market definitely sending a message to the Federal Reserve, but not being perhaps overly insistent about it. Just right now, there's a few things to get to before we get to next week's FOMC meeting. All right, let's get to some individual market movers this morning. For that, we'll get back over to London and Chloe Melly.
Good morning, Bonnie. We're seeing Oracle quite weak this morning, down about 7% after reporting higher expenses than expected because of all of the money that it is spending on data centers. And that actually overshadowed what had otherwise been quite resilient, quite strong results from the company. So we're down quite a bit there. Moving on to Navan, which is a company that manages business travel expenses. And it is up very strongly this morning, almost 20% after lifting its outlook. It seems that its AI-powered platform is gaining gaining traction in that this business travel is actually more resilient than personal travel, so it's benefiting from that. And finally, Supermicro is up this morning, rebounding after the weakness that we saw yesterday off the back of this plan to raise $7 billion in equity. And we're seeing actually across that tech sector really a bit of a rebound there. But in Supermicro in particular, up about 9% in pre-market trading this morning.
All right, Chloe, thank you so much. That's Chloe Melly there. And coming up in this hour, we discuss recent market volatility with Marvin Lowe of State Street. And Monti Saroya of Vista joins Bloomberg's Dani Berger from SuperReturn in Berlin. Let's kick it off with Oracle, though. As Chloe mentioned, shares taking a hit after heavy spending overshadowed fantastic results. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, I'm not quite sure what the problem is. So data centers and the stuff that goes in them is going to cost a little bit more, but why is the market balking at that? It's not as if it's costing Oracle a lot to finance this.
Yeah, I think it's this balance between incremental spend and incremental revenue. And if you see what they reported for the quarter on sales growth, it was pretty much in line with expectations, similar with the forward guide. The forward guide for Q1 was 27 to 29% organic growth. The market's at 27, so in that range. And if you look at the forward guide for the full year to May 2027, they talked about $90 billion of revenue in the markets at about 88, 89. So, I think the revenue side of the equation is very strong, but I think the market was really looking for a bigger upside in that outlook than they got to kind of compensate for the higher spend.
How worried should companies like Oracle be about this Wall Street Journal report that OpenAI thinks there might be a price war for AI tokens and, also that customers might be maxed out on their AI spending?
It's definitely a kind of thorny issue. I think as an infrastructure provider, Oracle should be relatively immune from that, at least in the short term, because it's the likes of OpenAI and Anthropic and Google's Gemini that are maybe going to have to be pitching that cheaper token pricing to protect or gain market share. And to some degree, they'll have to be absorbing the margin hit for that. But at some point, that will maybe kind of feed through to the likes of Oracle that are providing the underlying infrastructure. This to some degree is where the SpaceX story comes in. Obviously, Elon Musk has been saying for some time that putting data centers in space is a way to significantly improve the economics of the infrastructure.
On SpaceX, 4 times oversubscribed. We have a number now. Is that a lot oversubscribed given the size of this offering?
I think if it was a smaller IPO, you'd be looking at thinking, well, that's kind of what we'd expect. I think to be considered a hot IPO, personally, I think you'd probably be looking for at least 10 times oversubscribed. But it is a really big deal, and so you have to kind of balance that out. But yeah, I think maybe there are some institutional funds out there that put in some big orders that perhaps might end up getting a bit more than they expected in the final allocation that we'll get later today. And I would think probably the retail element of this deal is much more oversubscribed than the institutional side, given what we've been hearing in the market.
Matt, separately, Meta has now completed an operational split from Manus. Beijing didn't want this acquisition, and now it seems that data sharing is not going to happen between the two companies. What does this portend for Meta?
Yeah, I remember us talking about this a little while ago, and that probably this was the path that was going to happen. I think for Meta, the reason they bought this was because of its agentic AI capabilities. That's the way the market is going. And coming back to SpaceX, they've announced a deal to acquire Cursor, a real market leader in agentic AI. So Meta does need to improve, or has signaled that it needs to improve its capabilities in this area. So I think after it's got through the messiness of unwinding this failed deal, I wouldn't be surprised to see them on the hunt for other agentic AI acquisition targets.
All right, Matt, we'll talk to you again later in the program. That is Matt Bloxham of Bloomberg Intelligence. U.S. futures pointing higher now, recovering from that 5-week low. Let's bring in Ven Ram, Bloomberg M-Live strategist. So we had plenty tech selling, Ven, but we also seem to have this enthusiasm and dip buying and all of the other good things back in this market. Have we got some of the potentially negative drivers out of the way now, and are we back to all guns blazing?
Morning, morning. Yeah, I think that this dip buying is a lot of noise. It's not a signal. The signal we really are looking for is what we got from Broadcom last week. They missed the guidance, and that disappointed the markets a lot. And I think that was really an inflection point in the markets. And what you're seeing today with the Oracle that you've just been discussing is also a point in case, is that, Oracle, these were the very reasons tech AI was rallying earlier in the cycle, remember? Outsized capital spending equated a frantic rally. Now that same outside spending means that they are selling off. So it's a turning point in the markets, and we shouldn't miss that. And I think that the markets are going to muddle through from here because we've got the SpaceX big blockbuster IPO coming in stream. And then we've got OpenAI and Anthropic coming later on in the year. And I think that the markets are going to muddle through all of that. But I think we've already seen the top of this cycle for the markets. And I think that the markets are now beginning to think this is overextended, this is overripe, this fruit has got to fall to the ground.
Then, in terms of treasuries, we got past the CPI data, we got that blockbuster jobs report. We do still have the ceasefire-ish. I mean, it's very fragile at this point, and there's certainly no sign of the Strait opening, but oil doesn't seem to be rallying too much. What are we supposed to make of the Treasury-oil relationship?
Well, I think that the markets are riding high on conviction that, look, neither Trump nor Iran wants a full-scale skirmish all over again. And I think that, this is the summer fast approaching in this region where temperatures are soaring more than 45 degrees Celsius. So you've got to keep that in mind. So which is why the markets are kind of looking through all the bluster from White House regarding restarting of hostilities. And I think that, regardless of how this is playing out for treasuries, I think that it means, as I've been saying, Bonnie, for a long time now, I've been saying on your program that the 2-year yield is unsustainable, was unsustainable below 4%, and we are now doing 4.13. So I think that, this is a market that needs to be higher for longer, given the inflation implications.
All right, Ben, thank you so much. Wonderful, as always, Ben Ram from our Bloomberg M Live team. Let's now turn to the latest on the war in Iran. President Trump saying he'll keep bombing if Iran continues to refuse to sign a peace deal. This follows a second night of clashes between the US and Iran. Bloomberg's Abir Abu Omar joins us now from Dubai. It appears the strikes are over. Abir, how might Iran respond? What's it saying?
Good morning, Vani. Yeah, for the time being, the strikes are over. But as you have mentioned, this is a second day of an uptick in hostilities. Iran has already retaliated against the U.S. attack that happened overnight by attacking countries that it did attack yesterday as well, following the first U.S. attack that was Jordan, the Fifth Fleet of the United States in Bahrain, and also a U.S. base in Kuwait. Jordan reporting some 20 missiles or so in its airspace this morning. And so, look, the foreign ministry of Iran came out and said that the ceasefire between the United States and itself is effectively meaningless. Now, I've been getting asked the question of where does the ceasefire stand? And it has been quite fragile since it was reached on April 8th. But this uptick that we saw this week, certainly today and yesterday, with the back and forth between the United States and Iran, brings back this resurgence of dangerous escalations in the Middle East. Now, both sides maintain that broader conversations to reach the MOU that would reopen the Strait of Hormuz and extend the ongoing ceasefire, no matter how fragile it is, to 60 more days. They maintain that those conversations are ongoing. But President Trump did say to Fox News yesterday that he will hit Iran because he was disappointed with them essentially dragging their feet when it comes to getting to concessions to get this MOU underway. Iran, on the other side, saying again that the ceasefire is effectively meaningless because it was effectively broken, as we saw today and yesterday, and then with Israel's also incursion in Lebanon, a sticking point for Iran. And meanwhile, the Strait of Hormuz remains effectively shut. A trickle of shipments are getting through. We're hearing more shipments from countries in the GCC are going through, LNG shipments from the likes of the United Arab Emirates and Qatar. But ultimately, it's a fraction of what it was pre-war times, and the Strait of Hormuz, the reopening of it really is the ultimate concession that both warring sides want to get through the line. So we'll wait and see if more attacks happen. President Trump did say just now that he will attack Iran again if they don't come to the negotiating table.
Well, and in fact, Abir, as you were speaking to us, we had Iran's Persian Gulf Strait Authority commenting on X, repeating that the Strait of Hormuz is closed until further notice and telling ships with permits to cross the strait to await guidance. So effectively closed, as you said. Bloomberg's Abir Abu Omar, thank you. Now to other top stories trending on the terminal this morning. Hong Kong hedge fund managers are said to benefit from a change in the city's tax laws. The bill proposes tax exemptions for a wide range of alternative asset managers on so-called carried interest. The tax break is part of a broad push to attract global firms and executives to Hong Kong. Jim Chanos, bearish on SpaceX. He says the blockbuster IPO is being driven more by investor enthusiasm for Elon Musk rather than financial fundamentals. Speaking at a conference in New York, Chanos called it, quote, a hopes and dreams IPO. And the New York Knicks pulled off a record-breaking 29-point comeback to defeat the San Antonio Spurs in Game 4 of the NBA Finals. The Knicks won 107-106, capped off by a tip-in from OG Anunoby with just over 1 second remaining. The Knicks now lead the Spurs 3-1 the next game, Saturday in San Antonio. Coming up, the European Central Bank is set to raise interest rates for the first time since 2023. This is Bloomberg. This is Bloomberg Brief. I'm Dani Quinn in New York. The European Central Bank is widely expected to raise interest rates today for the first time since 2023. Oliver Crook, Chief Europe Correspondent, is at the ECB in Frankfurt. Ollie, there's obviously consensus the ECB will hike, but is there consensus that it's a good idea that it should hike?
Yeah, that's a very good question, Vani. I would say there is certainly consensus. The market is well prepared for this hike, 25 basis point. It's been really sort of well telegraphed by ECB governing council members ahead of the decision, ahead of the quiet period, all basically saying that inflation is now getting to a place where it's really beginning to worry them. They really need to take a sort of an insurance hike in order to make sure that it doesn't get entrenched, and that is effectively very likely what we're going to get today. Now, the question of whether or not the ECB should be doing that is a different one. It is one that has sort of split opinions among some economists. I think overall, people are on board with the ECB raising rates today. That being said, we have heard commentary from certain economists that think it's actually quite a bad idea. We heard from Jeffrey Yu earlier this week telling us that basically if you hike rates this week, you're effectively going to be cutting once again in the fourth quarter. I talked to Carson Bresky of ING a little earlier this morning, who says that basically, yes, it makes sense to raise rates, but this should be a one and done. This should not be a full sort of tightening cycle. So there is some debate out there. And again, when we think about the stagflation concern that the ECB is worried about, currently they're sending a pretty strong message that they're less worried about the stag than the inflation side of things. You've seen that represented in the core inflation, which accelerated at a faster pace in May than it did at the headline level. So all of these things are going to be going on into the ECB's assessment. And of course, we're going to be watching very, very closely, Vani, is not just the rate decision, but of course the new economic projections on growth and inflation. And of course, that press conference, all important, by Christine Lagarde at 2:45 local time here.
Yeah, exactly. Just on your comment earlier, I was reading Paul Donovan of UBS this morning saying that policy at the ECB is stuck in an unhelpful 2022 mindset. But the ECB is worried about growth, right? Will they revise those projections lower today?
So probably what you will get is revisions to the downside on growth, to the upside on inflation. So really a classic sort of stagflation kind of thing. And I think that what will be very interesting is to try to see how they sort of message this hike. What kind of hike is this? Is this a one and done? Is this a tightening cycle? I think they're going to want to leave themselves sort of maximum flexibility to be adaptive. But I think the theory here from the ECB is that effectively, if you act early, you may have to act less radically. That is the lesson that we learned from 2022 when they were accused of acting too late. But of course, Vani, there are lessons, and there's a real big policy mistake, and that was 2011, and that was hiking too early, cratering growth, and then having to immediately capitulate, and that is also something that they're going to want to avoid.
Absolutely. Well, markets certainly pricing in nearly 3 rate hikes for this year. Ollie, thank you so much. Bloomberg's Oliver Crook there at the ECB. Coming up, a look at what's making headlines in your front page news. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York, and it's time now for your front page news. First up, the New York Times reporting Republican hopes are dimming for a renewal of a powerful spy law, warrantless surveillance powers. Section 702 of the FISA Act will sunset unless lawmakers act by midnight Friday. The Times says President Trump alienated lawmakers with his choice of Bill Pulte for acting Director of National Intelligence. Next up, the Financial Times is reporting China abruptly cancelled two important diplomatic meetings with the EU this month as tensions build over soaring Chinese exports. The FT says Beijing is furiously lobbying against the EU's proposed Industrial Accelerator Act. That act would bar some Chinese products from public procurement contracts and limit takeovers of European companies. And the Wall Street Journal is reporting OpenAI is considering drastically lowering the prices it charges users for tokens, the unit of measurement AI firms use for their products. The Journal says OpenAI is looking to win customers from arch-rival Anthropic in anticipation of similar price cuts at Anthropic. Cuts, of course, could erode profit margins at both companies. Coming up, we're going to look at volatility and risk assets with Marvin Lowe of State Street. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stocks bouncing back. U.S. stocks recovering from a 5-week low after the U.S. ends another round of strikes on Iran. Spending concerns. Oracle falls as data center costs overshadow AI growth. And countdown to the SpaceX trading debut. SpaceX set to price today after attracting demand worth 4 times the shares on offer. So let's take a look at these markets then. Even as the Strait remains closed and oil remains subdued, we are seeing equities bounce. The risk mood improving once again today. Now, we did see Treasuries drop in particular after the US said it had completed strikes on Iran, but they fully recovered those losses. And you can see that futures are mirroring that as well. So the Nasdaq 100 futures pointing to a gain of 1.1% at the open. Bear in mind that even with the sell-off that we've seen, we're still up almost 13% on that index for the year. So really not a bad showing. It does seem that many of the movers are intact. And then on the Treasury side of things, the 2-year yield, as Ben Ram said earlier, did have to get above 4%. It's at 4.1246. He thinks it's sustainable around these levels. Of course, we got through the inflation data from yesterday without any panic. We'll get PPI data a little bit later today, which should give us more of a picture of the inflation story. All right, let's get to some individual movers now. Here's Chloe Malley. Chloe.
Good morning, Bonnie. We're seeing Oracle down a fair bit this morning, about 6%, after, as you said, its expenses came in higher than expected because of all of the money being poured into data centers. And so this overshadowed otherwise quite strong results from the company and is, of course, bringing up those questions again about this massive spend on AI infrastructure. So a bit of weakness there. Moving on to Navan, which is a company that manages business travel expenses and has lifted its outlook, and it's up very strongly, about 19% on the back of that. Its AI-powered platform is really gaining traction, and it's also benefiting from the fact that business travel, corporate travel, has been actually much more resilient than the personal leisure side of that travel business. And so we're up very strongly there. And finally, we are seeing space-linked companies up strongly as well this morning, especially Firefly Aerospace, about 6.7% ahead of this much-anticipated SpaceX IPO that we are waiting for.
All right, Chloe, thank you so much. Chloe Malley there in London. Let's get more on these market concerns over Oracle's heavy infrastructure spending. Matt Bloxham of Bloomberg Intelligence joins us now. So we'll acknowledge that the stock has been pretty volatile. We're very much off our highs. We are off our lows as well, however, Matt. But we are seeing a bad reaction. What is the objection of investors? Is it that these data centers are costing too much? I mean, it's not as if Oracle is having trouble financing them or having to pay that much to finance them.
Yeah, I think there's a kind of mixture of things going on here. I think part of it is the kind of disconnect between the increased spend on data centers and the the kind of growth in the revenue to support that. And if you look at the guidance for revenue for the fiscal 2027, they're talking about revenues about $90 billion, which is more or less where the market was, and it's no change to what they said before. So there's more spending coming, but there's no more near-term revenue coming in relative to what people were expecting. Now, they did increase the size of the forward order book, but that's a kind of multi-year play out of when that revenue hits them. So I think it's that kind of mismatch between the incremental spending and the lack of an increase in the near-term forward guide that's perhaps kind of causing some of this softness.
Matt, we got a number on the oversubscription rate for SpaceX. It's 4 times. Normally, that's nice, but it's not a whopping amount of oversubscription. But in the case of an offering this size, is it a lot?
Yeah, as you say, I think typically 4 to 5 times oversubscribed would be seen as, a good deal, not an amazing, but good. And I think when investors go into these kind of things, they always over order in the book, knowing that they're going to get paid back because of the oversubscription. I would say, given all the excitement about this IPO, 4 to 5 times is maybe a little bit on the low side of what we might have wanted to see. Perhaps the retail tranche is much more heavily oversubscribed. And we heard reports that some institutional investors had put bids in of up to $10 billion. I can't imagine any of them are really thinking that they were going to get 10 billion. So perhaps they might have been wanting a kind of a bigger oversubscription volume to make sure they kind of get an allocation that's more what they were thinking of. So I mean, let's see what's going to play out. Obviously the allocation is going to happen later today and it'll start trading tomorrow. But yeah, I would probably have been thinking they would have been looking for more than 4 times oversubscribed, if I'm honest.
Yeah, well, we'll know tomorrow and into next week how trading goes. Matt Bloxham of Bloomberg Intelligence, thank you so much. State Street's Marvin Lowe, looking at long-term economic growth ahead of today's PPI data, says this: while we expect volatility to continue into the summer, we think the economy continues to show strength even as the war drags on. Negative real wages cannot continue forever. But for the moment, greater employment levels and capex will support overall growth. Marvin Lowe, Senior Global Macro Strategist for State Street, joins us now. So Marvin, after the jobs report and yesterday's inflation data, are you comfortable with the Fed holding where it's at, or would you want the Fed to make some kind of a different move?
Yeah, I mean, I think that the growth justifies tighter conditions. To a certain degree, the market has already done it for them. But, they would need to follow through. So, I still probably in the camp that the next move should be a hike. But for the moment, I think that I'm comfortable with them seeing how this plays out over the summer, particularly with the new administration, if you will, that's coming into the leadership at the Fed.
So you're biased towards a hike. What about the balance sheet side of things? You seem to be suggesting in your note that it's too late to do something with the balance sheet, that ship has sailed. Do you mean that Kevin Warsh isn't going to be able to downsize it anytime soon?
Yeah, I mean, my view is that the financial markets right now need a great deal of funding and liquidity, particularly as credit has taken on such an important role in the overall activity within the markets, as well as the growth within the economy. And that credit really does start in the banking system. And it's a large Fed balance sheet that ultimately allows that banking system to continue to be engaged in the credit markets the way they are now. I think it's a very fragile type of relationship that exists, especially if the Fed starts talking about reducing that balance sheet significantly.
He's likely to try, at least according to previous comments, if not immediately, very soon. Would that actually cause some kind of market event? Do you think it could cause difficulty in funding markets?
Yeah, I mean, I think it's definitely a risk for me. It's probably an underappreciated risk. Everyone's certainly focused on the policy rate, and that's the a correct, visible view on how the Fed is leaning. There's talk that if they are able to cut, but ultimately tighten through the balance sheet, that maybe that keeps everything in balance. I do think the balance sheet is fragile enough, and really with valuations where they are. So that's really part of it. But it's a little bit more in that the economic growth that we have in this economy is very much driven on this capex, which has a large component with this AI trade, of course, and that is a very credit centric type of relationship that exists right now.
Yes, the other thing that I want to point out that you say investors might punish is what you're saying what you're calling any sleight of hand in using other measures of inflation to justify loosening financial conditions. So you think a move to, a trimmed mean or a median, that investors would actually punish that?
I mean, if the use of the alternative data, provides better insight into what true inflation is to the economy, it's a warranted discussion. And if the Fed moves towards something like that, and it makes sense, then investors and economists will understand that. But if it is a sleight of hand, a lot of the trim median right now is the lowest readings within the number of inflation readings that we could look at. It does have a downward bias in terms of the fact that it trims more on the downside than it does on the upside. To me, that's sleight of hand. And I think that we would see through that quite quickly. And we've seen how sensitive long yields are to kind of this inflation discussion, to this Fed credibility discussion. We're gonna interpret it the way that is correct in terms of how it's going to affect the economy.
Marvin, you mentioned that some of the growth that we're seeing at least has been built on capex, and obviously we know that. Does it make sense for all of these trillions to be being spent on capex, and inevitably when it has to slow down, and we already saw a little bit of a red flag with Broadcom and with Oracle yesterday, will the market and the economy balk, and might we be in trouble?
Yeah, I mean, it certainly does create a concern at some point. At this point, it really does seem as if the spend is insatiable to a certain degree. Every quarter, companies announce larger and larger spends. The equity raises are to a certain degree the extent of all of this build out, if you will. I would add that once the war is over, and it will end, we're going to have a lot of infrastructure rebuild within the Middle East also. So I think that creates continued demand for capital, which to a certain degree, positively affects the U.S. economy, but also, in my mind, continues to push up rates because that demand for capital remains as aggressive as it is.
Marvin, we actually have to leave it there, unfortunately. Fantastic speaking with you. Do come back soon. Marvin Lowe of State Street. Now to other top stories trending on the terminal this morning. The European Central Bank is set to hike rates for the first time since 2023. Economists expect a quarter-point increase, taking the deposit rate to 2.25%. The move would make it the first major central bank to hike rates in response to the war in Iran. Shares of Alibaba and JD.com sliding after Chinese regulators scolded leading e-commerce players for what it called misleading promotions. Regulators blasted companies for promising subsidies and failing to provide details of actual subsidies granted. And the New York Knicks pull off a record-breaking 29-point comeback to defeat the San Antonio Spurs in Game 4 of the NBA Finals. The Knicks won 107-106, capped off by a tip-in from OG Anunoby with just over 1 second remaining. The Knicks now lead the Spurs 3-1 the next game on Saturday in San Antonio. Coming up, we're live from Berlin's SuperReturn with Monti Saroya of Vista Equity Partners. This is Bloomberg. This is Bloomberg Brief. I'm Dani Quinn in New York. The world's top private market players convene in Berlin for this year's SuperReturn conference. Bloomberg's Dani Berger is live at the event with Monti Saroya, Vista co-head of the Flagship Fund. Dani.
Bonnie, thank you so much. That's correct. I am here with Monti of Vista. Monti, thank you so much for joining. Really great to have you. And it is this moment where there's this existential angst happening, not just in private equity, but in your specific sector in software. Vista's made this really large bet on what you all have called the agentic AI factory. Just on a basic level, what is the big bet that you're making?
Yeah, look, 2.5 years ago, we decided that agents were going to be the future of what software is going to be, and actually the future of what the economy is going to be. And as a part of that, we wanted to help our companies transition to becoming agentic. So what we did is we created a factory. We brought in all the big tech partners. We have Microsoft, we have OpenAI, we have Anthropic, we have Google, and they help us actually build and deploy agents into our software companies. So we started with 0 a couple of years ago, and now we have 52 companies that are deploying agents that automate workflows for software.
Robert Smith had recently made this comment, your CEO, basically, traditional enterprise needs to become agentic, yes, or they fail. There's a lot of people with a lot of software exposure just, in these halls itself. How much of this industry do you think gets that or is falling behind?
I think people don't understand exactly what agentic means and actually how to deploy it. Look, we were early 2.5 years ago. We've now figured out that it's not just building agents, it's the cost of agents. And that's the thing that you're hearing a bunch. There's a lot of angst around like, what is the cost of these tokens? What is the productivity of those tokens? So we've gone from building these agents in our factory to maximizing value using this thing called VC2. So that's the thing that we announced last week, which is vector core compute with Samba Nova and our partner Intel. So first we did the investment in Samba Nova, and Samba Nova allows us to do really fast inference at very, very cheap cost. And then the second thing we did is we announced Vector Core Compute to have our own access to cheap inference at high speeds. That's the future of where agentic is going.
So does that mean your portcos get that priority access to it? So
That's correct.
how much capacity is there at this moment, or is this still very new?
Look, we just launched it last week. We have our first data center already up and running in LA. It's the first big inference center. We're going to have 5 different inference centers by the end of this month. We'll have 50 megawatts up by the end of this year, and the goal is to get to 250 megawatts by next year. So we're going to have a lot more inference and compute accessible to our companies to build more agents.
So it's not only a change in just understanding what agentic is, but it's also just a fundamental change in the business model, because Vista's business model for your portfolio companies, asset light, huge margins, heavy cash flow. How much have you had to rewire your brain as an investor to now be investing in a way that's decidedly asset heavy?
Yeah, so the way to think about it is we service enterprises. At the end of the day, we are the tech provider to an enterprise. And what the enterprises are asking us, number one question 18 months ago, I need to deploy AI. How do I do that? My CEO talks about it on earnings calls. We're like, great, we'll build you agents, and the agents will be built through the agentic factory. And then today, and basically earlier this year, people are like, wait. The CFO is saying we're spending a lot of money on AI. We don't have anything to show for it. How do we measure it? What's the cost? And we said, you know what? Look, we're going to solve it, and we're going to give you one full package. It's going to include the cost of tokens. They're going to be high speed. It's going to come from VC2, from our own factory, and then our own factory agents will use it, and we will rack and stack it and give it to you as one big solution. The truth is that's what customers want. That's what they want to buy. They don't want to buy generic intelligence. They want to buy specific intelligence that does specific workflows for their businesses.
By the way, how on board have your CEOs been with all of this as you've truly made your companies agentic? Because for them, I'm assuming it's quite a large change too.
Yeah, but look, the reality is we work in tech, right? And so every decade or so, there's a giant wave. The last time I was at the job before I had Cisco, it was a job I had before Vista, was 20 years ago at Cisco, when we went through this giant infrastructure build out for the internet. Now we went through another infrastructure build out with compute for GPUs and inference. And I think the reality is our CEOs are used to it. They're tech CEOs, and they're very good at execution. At the end of the day, that's what's going to make the difference for software. And you're seeing it in the public markets. The software companies that are performing well, the Datadogs and Snowflakes, have made the pivot to agentic. They're releasing agents, and they're growing faster. And that's what you're seeing in our portfolio.
But again, the transition for Vista, I think, is really fascinating, because there was maybe rightly or wrongly this perception that in the true uptick in the frenzy of 2021, maybe you missed out versus some of your larger competitors when it comes to software. Do you think that this gives you pole position, the fact that not only are you having access to compute, but compute at a specific cost as everyone else is facing this rising price pressure?
Yeah, look, I think the big unlock for us is historically we've been change management agents. That's how we've actually created deals and created returns. Our entire history over the last 25 years is making companies better in change management. And when we saw AI come out, we addressed it from our lens, which is let's create a factory, let's create best practices, let's help people deploy it, let's create these cheap, fast tokens that are coming from VC2. And we've always approached it from an operational lens, and that does give us an edge, right? All these other folks are now running and trying to use deploy codes and trying to catch up. And the reality is the world is moving fast enough where we're seeing it come towards us.
That's interesting. So those kind of deploy co-models, do you think that's too slow itself, that's not really a successful one?
Look, the reality is, like, if you start a services company, the services company is going to want to generate revenue, and it generates revenue by charging your companies a lot of money, right? Like, in our business, we're making our businesses successful and our portfolio successful, not by making a third-party company successful, right? Our goal is go and actually have access to the cheapest, and fast is a keyword here, fastest tokens, fastest inference, so we can go capture market share versus our competitors.
So one of the things Robert has also been really outspoken on is just how much this changes the workforce itself. I believe it was at SuperReturn last year that there were audible gasps in the audience when he said 60% of the people in the audience will be looking for a job by this point next year. You see on the ground what happens when you truly agentify a company. He had made the comment, you've already converted 54 of your 93 companies to actively run on AI agents. When that happens, what is the typical percentage of real humans that get taken out of the system?
Look, the reality is like the actual job changes, right? When these agents come into play, either you're using AI, and I would argue half that room doesn't even use AI today. By next year, maybe all of them will, but most of them don't use agents.
You think it's half that room doesn't use AI?
The reality is, I don't know if people, today the use case that people use are chatbots and generic search.
True.
Are they using AI to actually automate a workflow? It's quite complex to actually use it to go do your day job, right? And I think what Robert was saying is half this room is going to be using agents to automate a bunch of what they're doing. Maybe they do something more higher value, and that's the goal. I'm not a big believer that knowledge workers are going away, but I am a believer that the work of knowledge is going to change. You're no longer just going to be an input-output into a machine. You're going to do real value work, and the agents are going to work for you.
Do you think, though, so the rest of the world will face these cost pressures, right? It's a second wave of disruption coming as the cost of compute goes out. Do you think companies are going to have to make real decisions? Because of how much I'm spending on compute, I got to let go of people. And that's the only option I face.
There's two things that are going to happen. One, the infrastructure build-out is geopolitical, meaning we have borders to where intelligence is being built out. The first time around, we were able to build the internet, and you could use compute from China, you could use it from wherever. Now it's actually, you have to use it geopolitically where you are. So that's what's driving the cost of compute. But the hack on that is if you're able to access high-speed, fast tokens, you can go win bigger market share. And that's why we did VC2. We're building VC2 inference centers in existing locations, using existing power in existing buildings, where there's no actual rezoning or any of that stuff. So our ability to go capture a bunch of high-speed tokens quickly will give our customers an outsized right to win.
Well, so it's not only private equity and private capital broadly that is trying to figure this out. It's just corporate America.
It's corporate America.
So in that, you've had some interesting exits in an industry that has struggled for exits. One, notably, a couple months ago to United Health.
Yeah.
How much are corporates turning to you and saying, what solutions do you have in your portfolio that will help us make the leap that you're making?
The reality for corporations is that they're waking up to a world in which they now need to be AI native as well, right? The thing that the healthcare providers, insurance companies, banks, what they've figured out is if we don't adopt AI, we may not have a right to win over a 20-year period. So what are they doing? They're acquiring assets that have AI in them and deploying them internally. So actually, I think what you're going to see is non-tech companies increasingly buying software, AI, agentic businesses to help them transform. And that's what happened last time around. So last time we went from on-premise to SaaS, and a bunch of these cloud businesses got built. You saw a bunch of strategists jump in and buy cloud businesses so they become more cloud.
Just with that, how have valuations changed? Because software as a whole obviously took a hit in the SaaS apocalypse. If it's an agentic AI software company, are we still commanding like 20 plus still?
It's massive. It's a massive difference. The first time you saw it was 2 times revenue for on-prem. It was 6 to 7 for SaaS. What you're seeing on the agentic side is 15, 20, 25 times. It's a massive multiple. The biggest thing is we've uncapped our ability to generate revenue now, right? So historically, people don't realize that all of our revenue was capped by the number of knowledge workers. It was per seat. And now we have all these agents running around automating workflow, and they can be uncapped. So as long as you're doing something that's providing productivity, and that's the key, right? Like you see the messages coming out from the big CEOs. What do the tokens cost? How are you using them? What's the productivity? We can show you the productivity of our software, and we can tell you, hey, we can serve you at VC2 through a higher speed, lower cost token. Businesses are, oh, that's going to help me adopt.
Monti, thank you so much. Really appreciate your time this morning. It's been so interesting. Bonnie, with that, I'll send it back to you. That is Monti Saroya, the co-head of the Flagship Fund at Vista and a senior managing director.
And Bloomberg's Dani Berger in Berlin. This is Bloomberg. Here's your picture for your trading day. Futures pointed higher even after the Oracle disappointment. Plenty of voices out there saying all the drivers are still in this market. That's it for Bloomberg Brief.